Hello everybody, Dwayne Shepherd here, DRFX Forex Swing Trading. Gonna be taking a quick look at the overall performance of the methodology over the last 13 months and highlight the main advantages of this style of trading relative to day trading as a way of providing a realistic source of long-term income and wealth creation for everybody who trades this way. So let's start off by taking a look at the early stages of this methodology. Here we see that the first trade gave us a little bit of a shock with a 100 pip loss straight out of the gate. However, after a couple of trades and a few months later, the methodology was able to produce consistent gains with only a few losses along the way. Overall, the methodology targets between 100 and 200 pips. However, there are cases in which we have to be content with trades below that 100 pip minimum. Now, one of the main elements of the strategy is to hold trades for a maximum number of days. That established holding period ensures that we give the market enough time to reach our targets while not holding out longer than is necessary for pips that might not be there. So it is a way of containing our emotions and containing any greed that could creep into our trading strategy, so that we maximize on the number of trades, we maximize on the number of pips that we can get per trade while minimizing the element of greed that can compromise our trading results. So there are times when trades will test that holding period, and when the trading period has ended and the market has not yet hit our trading target, we close that trade for whatever number of pips are on the table at that point in time. So that is one of the elements of the discipline that is needed for this type of trading. So nevertheless, there are occasions in which we do hit our 200 pip target, which came later on in this period here. Here we see that we hit a 199 pip trade target on the pound Canadian, which, if memory recalls, was a false breakout reversal in a consolidation setup. The New Zealand Swiss franc was a pennant breakout, and in this case we actually closed out for 31 pips above our 200 pip limit. This was actually an occasion in which the New Zealand dollar spiked pretty sharply over the weekend, so the slippage actually worked in our favor. However, subsequent to this, we went into a bit of a slump, a bit of a negative set of trades, with this rose of a 200 pip trade in between these turns. So the last couple of trades have been a little bit unlucky, but nevertheless the overall picture is still pretty good. 35% return over 12-13 month period is pretty good by most standards, across any type of asset class, especially when we're talking about a fairly conservative way of trading in which we only target the best trading opportunities within a month on 2 to 3 occasions. So with that in mind, this has been a very positive performance so far, and it augurs well for the long-term profitability of this strategy in order to be able to generate consistent gains and long-term wealth creation for anybody who uses this strategy. So with that in mind, we can take a look at what lies ahead in the very short term for this strategy. Assuming that that rate of growth continues, we would essentially be only 6 trades away from achieving a 100% return from the strategy. Assuming that we have trades over the next 3 months occurring on average twice a month, we should be able to hit that target fairly comfortably before the year is out. So this is essentially telling us or showing us that trading can be profitable if it is done by targeting the major movements in the currency market and targeting the highest paying trades during the course of the month. You only really need to risk between 2% to 5% on each of these trades to be able to produce these types of returns. These rates of returns reflect a 5% rate of 5% risk per trade that I use in my trading. However, persons can use smaller risk per trade or even higher risk per trade depending on your risk tolerance. But at the end of the day, once you're targeting the major movement in the market of between 100 to 200 pips with a fairly accurate methodology such as this, then you're gonna be putting yourself on a very consistent path of profitability over the long term. So this is the situation in a nutshell. Very promising rate of return over the last 13 months, and it augurs very well for the very near term and long term performance from this strategy. So let me finish by basically showing you that the rest of the document that you'll find on the website highlights the summary, provides a summary of all 15 trades, the justification behind each of these trades with reference to the technical theories, and I show in detail the graphical representation of these trades and as well as an explanation of the results, both winning and losing, that took place for each of these trades. One of the main elements that you will see throughout this document is the fact that there's a tremendous need to have a level of patience whenever we're holding our targets, whenever we're trading and have to hold trades over a number of days. Take this trade for example on the Aussie Kiwi dollar on September 3rd last year. This was a consolidation breakout that was expected to reach its target, having started with a very strong bullish candle that was breaking above this range setup, which was at the resistance of an even larger consolidation pennant setup. So given the fact that we were breaking out of two consolidations, the breakout was expected to produce a fairly sharp movement bullish that was expected to take a very short time to reach our target. However, the market took a very long time and actually took 7 days before it actually rallied and produced any meaningful gains in terms of profitability. However, the trap or the difficulty with swing trading and holding trades for several days is the temptation to cut a trade just early just because it has not reached its target or it's taken a longer than expected time to reach its target based on the expectations of the setup that we're trading. However, as you will see here, it was worth the wait, even though we did not get the 200 pip target that we had intended. It was still worth the wait because at the end of the day, when we close the trade at 70 pips, you will see that eventually the market reversed there shortly thereafter. So this is one of the reasons why we need to be patient to be able to capture our trading targets without being patient and closing our trades earlier than expected just because the market is taking a longer time than we expect to hit our target. So there are times when we need to, one, wait for the holding period to be completed, and two, exit trades at lower than expected, lower than targeted profits in order to avoid pullbacks in the market, such as these, which would have led to a loss on the trade altogether. So swing trading has its benefits in terms of the large number of pips per trade, but in order to be able to do that on a regular basis, we have to let the market move towards its target. We have to allow the market to wave and to essentially do what it normally does in moving from one target, in moving from our entry to our target. So this is the benefit of swing trading: large pips over few trades, but with the necessary discipline of allowing the market to reach its target without human intervention. So let's continue to trade and continue to make profits over the long term. Take care.